Hi everyone, welcome back to the US CPA classes for regulation exam. In this particular video, we'll be discussing in detail of US individual taxation for gross income part 5. So in this video, we are going to cover other income including the non-passive activity, and we also do some practice question. So let's dive into to understand other income, non-passive activity and some practice questions.
So far in chapter 3, which is like capital gain related taxes, capital gain related income, depreciation, recovery, all these things we have started in chapter 3. And in chapter 4 is more of like income related. So we have covered, like all routine type of income. Now we are starting with the special categories of income basically, and how we need to give the treatment for those special category of income. So first is like passive income. So before jumping into the passive income, we all need to understand what is passive activity, right? Any idea like what is passive activity? Or like we touch base when we had like introduction or overview of the US taxation. But if any of you remember like what we have discussed, because like this was considered in the terminology section also, which I shared, like which is different compared to India. So if you remember, like we discussed this point earlier as well. Any idea what is passive activity? Anything you remember from first or second class?
Sir, any income for which taxpayer is not actively involved
Mm-hmm.
or it is not the direct source of income,
Mm-hmm.
and those income is also considered as a part of income and they should be reporting in their main reporting when they are filing return. So
Mm-hmm.
example might be like any property which is lying and he has put it on the rent,
Mm-hmm.
or he is a passive partner,
Mm-hmm.
or similar kind of like in any trade and business where he is not uh, totally or actively involved, but
Mm-hmm.
he is eligible to receive uh,
Mm-hmm.
revenue out of it, maybe
Mm-hmm.
dividend or shares, something like.
Mm-hmm. Yeah, no, very good. Anyone else would like to share his or her experience or anything would like to add to Rakesh's point? Mm. Matthew, Krishan, Prakash, Manish, Giri, anything you guys would like to add? Yeah, yeah. I think Rakesh, you have covered like more or less exactly the thing which we have discussed. So yes, passive activities are those activity in which taxpayer is not actively involved. So we'll be understanding in detail when it is called the taxpayer is not actively involved, and when it is considered that taxpayer was actively involved. Right? Accordingly, we can identify the respective category of income, whether to consider as active activity income or passive activity income. But normally, in a layman language or in general terms, the activity which is like interest income, dividend income, rent income, royalty incomes, right, are being generally considered as like passive income. Or you can say another point which we have discussed earlier is limited liability, in which partnership, in which you are like kind of passive partner, not actively engaged in day in day out operation of the business, but rather you have invested capital and you are expecting return on your capital. Right. So first, let's understand what is non-passive activity. So business in which taxpayer materially participate or individual is considered to be material participant if any one of the following conditions are met. So materially participate, if individual is materially participating, that is considered as active activity, right? An individual is considered to be materially participated if any one of the following conditions are met. The first one is activity for more than 500 hours in a year. So the taxpayer is being engaged in any activity for more than 500 hours in a year. then that activity is considered as active activity. That means, for example, if person is into the real estate business, right? So it may be possible that he or she is the owner of the property and keep on renting the property or exiting the property, right? And is being investing almost 500 hours in a year. In that case of scenario, even though it's a rental income, but it is being part of the business income and respective expenses also being allowed. Second is substantial participation in the activity for the tax year. That means majority of his time has been invested in that particular activity. So this is, like this include like a lot of professional judgment, and I would say detailed calculation as well. Right? For example, an individual is being involved in, like, let's assume 10 different category of activity, right? So he might be doing, like a job, he might be working in cafe, he might be doing some work with real estate agent, he might be doing some construction work, right? Or he or she might be doing some shopkeeping work, right? So it is possible in, like it's very normal in US that an individual would be working for multiple things in a year, right? Considering that scenario in mind, then how do you identify? For example, he or she has not worked for any particular activity for 500 or more. All the activities for which he or she has worked comprise of 100 hour, 200 hour, 300 hour, 400 hour, but none of that is more than 500 hour, which you can straightforward you can check the box that this is to be considered as active activity. In that case of scenario, the activity in which the taxpayer has invested majority of his time, almost 75% of his or her time, then all those activity are being considered as active activity, right? So when involved in different activities, substantial activity should be at least for more than 100 hours. It means any activity for which an individual is working, right, should be more than 100 hours, then that activity can be considered as active activity. Fourth is 5 out of 10 immediately preceding tax year, individual materially participated in active activity. So the respective activity which is being considered as the active activity, in that the taxpayer must be actively working for 5 out of 10 preceding, right? Fifth is the activity is a personal service activity like doctor, lawyer, CPA, enroll agent, performing art, consultant, right? In which the individual materially participate for any three preceding tax year, whether consecutive or non-consecutive, right? So all these activity are being considered as active activity, and any activity which does not fall into this category is considered as passive activity. Any doubt what is active activity or what is passive activity? Yes, no, question or any example you would like to share with the group? Clear so far?
Yes, sir.
Hmm. So I'm just quickly summarizing any activity on which taxpayer has spent more than 500 hours. If the taxpayer has not spent on any activity more than 500 hours, then all the material activity. If he or she has not specifically worked on any particular material activity, then all activity for which he or she has invested more than 100 hours could be considered as active activity. And 5 out of 10 immediately preceding year, the individual was materially participating in those activity, and the activity is of personal service activity like doctor, lawyer, CPA, enroll agent, advisors, right? So which involve like individual time in giving the consulting, right? So in which individual materially participate for any three preceding tax year, whether consecutive or not consecutive, right? Clear everyone? So here, let's identify what are the active activity and what are the passive activity and what are not passive activity. So wages, will it be active activity or passive?
Sir, active.
Right? So wages will be earning by doing the work. Same way like salaries also. Right? Next is income from limited liability partner, income from limited partnership. Will it be active activity or passive activity?
Active.
Why?
Sir, active in case like involvement is like criteria we see 500
No,
hours or 100
limited
hours.
partnership means only a passive partner.
Okay.
Right? So for passive partner, it is not a active activity. It is a passive activity. Right? Schedule C income. Schedule C is what? Sorry? You're saying something? Okay. Schedule C. In Schedule C, you'll be mentioning always business income. So will business income active income or passive income?
Active income.
Right? So that is an active income. Interest, dividend is active income or passive income?
Active income.
No, it is a passive income normally if the individual is not materially engaged in those activities. Right? Capital gain. If it is on business property, then it is active activity. If it is from non-business item, then it is passive activity. Income from active activity, rental income. So non-real estate professional.
Passive.
Right? So net passive activity. Net passive activity loss can be carried forward infinitely to adjust with the future passive income. So the thing catch over here is passive loss you cannot adjust against the ordinary income, and passive losses you cannot adjust against the capital gain. So you need to maintain a separate record if you have passive loss that you can carry forward infinitely, but that can be adjusted only against the passive income, not against the business income. But in the year when taxpayer dispose of the interest in passive activity, the current year loss plus earlier loss from passive activity can be offset against the current year active income. So it means, for example, you have a property on which you are earning rental, but your maintenance expenses are more than rental and you are continuously earning losses on it, right? So all those losses are being considered as passive activity loss, right? Are you guys with me?
Yes, sir.
So that passive activity loss can be set off only against passive activity income. But unfortunately, your client do not have other source of income, right? In that case of scenario, this is considered as a passive activity loss, right? In future year, you can carry forward. In next year, you have sold that property and you earned a capital gain. So against that capital gain, you can adjust the earlier period passive activity loss, right? This is what it means. Make sense? Clear, everyone?
So this scenario is only applicable for a rental property and no other income.
No, it can be, for example, you have debenture, right? That is on that you are earning interest. So that is also your passive income. But like if you sold those debenture at loss, so then it may result into a passive loss, right? So in future you can adjust against the passive income. Same way, like
Okay.
maybe like other thing like royalties or maybe for stocks, dividend, right? So you need to consider case by case basis, I would say, right? So for example, like sale of rental property on which owner was incurring passive losses. Generally, loss from passive activity may only be used to offset income from passive activity, and tax credit related to passive activity can only be used to offset the tax attributable to passive income. Any excess credit is carried forward to offset the future taxes on passive income. That means if you have any passive activity loss in current year, you can adjust against other passive activity income. But still, if there is a total net loss, that you can carry forward, and in future you can adjust against the passive activity income. Note over here is any carryover credit on terminated activity may be lost forever if they cannot be fully utilized in the year of disposition. So it means when you are selling that asset on which you are incurring passive activity loss, and during the year of sale, your income is less than carry forward losses. Your gain is less than carry forward losses, right? To the extent of gain, you can adjust, but beyond that, if you have any loss, that is a loss forever. So you cannot adjust that again in future. Make sense? Yes, no. Example here is carry forward losses from rental property and disposition of property in current year, and maximum deduction from residential rental property losses $25,000. Rental real estate exception. A certain taxpayer may deduct real estate rental losses from active and portfolio income, and this treatment applies to taxpayers who materially participate in real property trade or business, both individual or closely held C corporation may qualify. What it means? There may be possibility that you are recording any passive activity loss on any property, but for that property you are being more actively engaged and you are meeting the criteria of active activity basis on your engagement. Then in that case of scenario, you can adjust against the normal taxable income. So individual must meet both of the following tests. First is more than 50% work for real estate. Second is at least spend 750 hours during the year on real estate property. And the marriage filing jointly couple meet this requirement only if one spouse separately satisfy both the requirement. Right? If you are a married filing jointly, even though one spouse meet both the criteria, you can consider that as active activity income. Closely held C corporation mean the company where more than 50% of gross receipt is from real property business. So closely held C corporation meet this test criteria if more than 50% of their revenue, the gross receipt, is from real property, right? And other taxpayer who actively participate in the rental activity but not meeting the above limit, for example, involved in decision making, and own at least 10% of the activity may also deduct the following amount of loss from active and portfolio income. So the loss deduction is equal to $25,000 or, right, underline this word, or $25,000 minus 50% of AGI minus $100,000. So this is a formula given in the tax law. This is not something which we have created. It is being part of the tax law, right? That how you need to consider or calculate the loss which can be allowed in future year. So for married filing separately, loss is 12,500. So that is 12,500 minus 50% of AGI, whichever is lower, right? In case of married filing jointly, it is 25,000. Married filing separately, it is 12,500. Any doubt here? So far, so good?
Yes, sir. Yes, sir.
Okay. So let's do some practice question. John and Jim had income from investment in 2023. They also earned a substantial amount in wages. Most of their dividend and interest is reinvested. The reinvested income include $2,000 in dividend from mutual fund, interest from saving account $3,000, and interest from certificate of deposit $4,000. Dividend from stock of $5,000 was received and spent. Interest of $1,000 earned in 2023 on a loan from a friend was not received until the following year. How much interest and dividend income must John and Jim report on their tax return for 2023? So what is the call of the question? How much interest and dividend income we need to record on joint return, right? So what is the call of the question? You need to identify dividend and interest income, right? So John and Jim had an income from investment. They also earned substantial amount of wages. Most of their dividend and interest are reinvested, and the reinvested income include $2,000 of dividend from mutual fund plus interest from saving account. How much?
3,000.
3,000. And interest from certificate of deposit 4,000. How much is it? 4 and 3, 7 plus 2, 9.
9.
Dividend from stock of $5,000 was received and spent. That means dividend from stock is how much?
5,000.
5,000.
$5,000, right? And then
14.
interest of 1,000 earned on loan from a friend but not received. So until you receive, you will not book this income. So how much is the total income?
14.
$14,000, right? So 14,000 is correct answer. Clear, everyone? Second
Yes,
question. Second question. Which of the following statement is correct concerning the foreign earned income exclusion? So exclusion is 120,000 and foreign tax home expenses, right? If you remember. So a taxpayer cannot take a credit of foreign income taxes paid on income that the taxpayer exclude from US tax. Second is a taxpayer can take a deduction of foreign income taxes paid on income that taxpayer exclude from US. A taxpayer can take credit for foreign income taxes paid on income that the taxpayer excludes from US. A taxpayer can take credit for foreign income taxes paid on income that taxpayer excludes from US. So which option is correct? The first is taxpayer cannot take credit, right? So can a taxpayer take credit or not for foreign earned income?
they can, yes.
So taxpayer cannot take credit for foreign income taxes paid on income that the taxpayer exclude from US. So if you are not included that income, then will you be taking benefit or not?
Not it.
Not, sir. Right. Second is a taxpayer can take a deduction. So foreign tax credit or foreign earned income exclusion, is it a deduction or exclusion? Right. So foreign a taxpayer can take deduction but not credit, right? Whereas he or she can take credit, not deduction. So second option is incorrect.
False.
Sir, in all 4 cases, you have mentioned that in all 4 options, you have mentioned that income, the taxpayer is excluding from US tax. So that means that taxpayer is not including their foreign income, not disclosing the income from foreign out of US. Then how this person can deduct deduction or a credit if he is not
Yeah.
including the income?
Yeah.
So he can take credit only in case where he's showing income from outside United States, and then take the credit in case he has paid a tax on that
Yeah.
foreign income, and
Mm-hmm.
US has treaty with that
Yes.
nation only.
Yeah. Very
So
true.
none of these four are the correct statements.
Yeah. So let me go one by one. So first two statement we have gone through. Third is a taxpayer can take credit but not a deduction for foreign income taxes paid on income that the taxpayer exclude from US taxes, right? If the income is being excluded from US taxes, what you are saying is absolutely right. So third option is also not correct. A taxpayer can take a credit or deduction of foreign income taxes paid on income that taxpayer exclude from US taxes. The taxpayer can take credit or deduction for foreign income taxes paid on income that the taxpayer exclude from US taxes.
So first one is correct. Cannot take a credit.
Yeah, so the taxpayer cannot take a credit or deduction for foreign income taxes paid on income that the taxpayer exclude from US. Yes. Make sense, Rakesh?
Yes, sir.
So first option is correct option. And here is the typo error. Okay, so next question is John is a US citizen living and working in France for all 2023, right? So John, she's working in France for entire 2023. She received wages $150,000 and she received dividend $10,000. Alimony she received $20,000 in 2023. She decided to use foreign earned income exclusion available to her and filed Form 2555. What is the amount of John foreign earned income before any limitation? What is the limitation? 120,000 plus foreign tax home, right? So what is the call of the question? How much is the total income to be considered as a foreign income before exclusion? So $150,000 which she is earning as a wages, will it be income, foreign earned
Yes.
income
Yes, sir.
Yes.
before
Yes, sir.
exclusion, right? Second
Yeah.
is the dividend she is receiving. So dividend is not earned income, right?
Yes, sir.
Right.
And alimony
Is
is
also
Is
not
earned,
earned.
is also
It's a
not
order.
earned. So how much is total?
1,50,000.
$150,000. Clear, everyone?
Yes.
So the first option is correct.